A recent Vanguard study from 2026 found that 73% of investors haven't rebalanced their portfolio in over 2 years, and it's costing them an average of 6 figures by retirement. Here's the scary part. If you started investing in 2020 with a balanced 60 to 40 stock bond portfolio and never touched it, by June 2026, you're probably sitting at 78% stocks without even realizing it. That means you're taking way more risk than you planned. And when the next market correction hits, you're going to lose sleep. I'm going to show you the exact rebalancing system I use, when to do it, how to avoid brutal tax bills, and the biggest mistakes that destroy returns. By the end of this video, you'll have a clear action plan you can implement today. Let's dive in. First, let's talk about why rebalancing actually matters. Imagine you start with $10,000 split evenly between stocks and bonds. Stocks do great and double to $10,000. Bonds stay flat at $5,000. Now you've got $15,000 total, but 2/3 is in stocks. You went from a balanced 50 to 50 to a risky 67 to 33 without making a single decision. That's portfolio drift, and it's silent but deadly. The solution? Sell some stocks, buy some bonds, get back to 50 to 50. That's rebalancing in its simplest form. But here's where it gets interesting. Rebalancing forces you to sell high and buy low automatically. It's counterintuitive, but it works. A Morningstar study from early 2026 showed that investors who rebalanced annually beat those who never rebalanced by an average of 0.4% per year. That might not sound like much, but on a $500,000 portfolio over 30 years, that's an extra $127,000. Plus, and this is huge, rebalancing keeps your risk level consistent. You don't accidentally end up with a portfolio that's way too aggressive right before you retire. So when do you actually need to rebalance? There are 3 main triggers you need to watch for. Trigger number 1, calendar-based rebalancing. Pick a date, once or twice a year, and rebalance no matter what. Many people choose January 1st and July 1st. This is simple and removes emotion from the equation. You're not trying to time anything. You're just maintaining your target allocation. Trigger number 2, threshold-based rebalancing. You only rebalance when an asset class drifts more than 5% from your target. So if you want 60% stocks, but you're now at 65% or higher, time to rebalance. If you're still between 55 and 65%, you're good. This method can save on transaction costs and taxes because you're not rebalancing unnecessarily, but it requires more monitoring. Trigger number 3, life changes. Got a promotion? Having a kid? 5 years from retirement? These are rebalancing moments. Your target allocation should change as your life changes. A 25-year-old and a 60-year-old should not have the same portfolio mix. Here's my recommendation. Use a combination. Check quarterly. Rebalance if you're 5% or more off target, and absolutely reassess when life changes. Now let's talk about the mistake that costs people the most money. Rebalancing in taxable accounts without thinking about taxes. When you sell investments in a regular brokerage account, you trigger capital gains taxes. In 2026, that could be 15 or even 20% of your gains. So if you made $50,000 in gains and rebalance, you could owe $7,500 to $10,000 in taxes. That destroys the benefit of rebalancing. Here's the smart move. Prioritize rebalancing inside tax advantage accounts first. Your 401k, IRA, Roth IRA. These have 0 tax consequences when you rebalance. In your taxable account, use new contributions to rebalance instead of selling. If you need more bonds, just buy bonds with your new money until you're back on target. Another strategy, tax loss harvesting while rebalancing. If you have investments that are down, sell those to rebalance and use the losses to offset other gains. Bottom line, never rebalance in a taxable account without considering the tax implications. It can turn a smart strategy into an expensive mistake. Let me walk you through my exact rebalancing process step by step. This is what I do every quarter, and it takes about 30 minutes. Step 1. I log into every account and write down my current allocation. Stocks, bonds, real estate, international, everything. Step 2. I compare it to my target allocation. For me, that's 70% stocks, 20% bonds, 10% alternatives. Yours will be different based on your age and risk tolerance. Step 3. I identify what's overweight and what's underweight. If something is more than 5% off, it needs adjusting. Step 4. I decide where to make the trades. Tax-advantaged accounts first, then use new contributions in taxable accounts if possible. Step 5. I execute the trades. Sell the overweight assets, buy the underweight ones. Usually takes less than 10 minutes once I know what to do. Step 6. I document everything. I keep a simple spreadsheet with the date, what I did, and why. This helps me see patterns and learn over time. That's it. 6 simple steps, 30 minutes for times a year. It keeps my portfolio aligned with my goals and removes all the guesswork. Now, what if you want to make this even easier? There are tools that can automate most of this process for you. Robo-advisors like Betterment and Wealthfront automatically rebalance your portfolio. They use threshold-based rebalancing and tax loss harvesting built right in. If you're using Vanguard, Fidelity, or Schwab, they all offer automatic rebalancing services for free or a small fee. You just set your target allocation and they handle the rest. There are also portfolio tracking apps like Empower and Kabura that show you when you're out of balance across all your accounts in one dashboard. My take: if you're just starting out or have a simple portfolio, automation is perfect. As you get more advanced, you might want more control. Either way, having a system is what matters. The worst strategy is having no strategy at all and letting your portfolio drift for years. All right, here's what I want you to do today. Right after this video, log into your investment accounts and check your current allocation. Write down the percentages. Compare them to what you think your target should be. If you're more than 5% off on any major asset class, it's time to rebalance. If you've never set a target allocation, use a simple rule of thumb: your age in bonds, the rest in stocks. So if you're 30, go 30% bonds and 70% stocks. Then set a calendar reminder for the first of every quarter: January, April, July, October. Each time, spend 30 minutes checking and rebalancing if needed. If this video helped you understand rebalancing and you want to take control of your financial future, smash that like button and hit subscribe. Remember, the difference between investors who build real wealth and those who don't usually comes down to simple habits executed consistently. Rebalancing is one of those habits.